All right, welcome everybody. We'll get started here in about another minute or two as we let folks join in the webinar. You can see everyone's starting to come in right now. So just about another minute and then we'll get going. All right, good afternoon and welcome to the Foundation for Teaching Economics webinar, Bidenomics, Boom or Bust. Today's talk will highlight new data and trends in the US economy and the evolving policies of the new administration. I'm Ted Tucker, Executive Director of the Foundation, and it's my pleasure to introduce our speaker today, Professor Scott Baier. Professor Baier is currently the chair of the Economics Department at Clemson University. In addition, he has served as a visiting scholar with the Federal Reserve Bank in Atlanta. He was a senior economist in President George Bush's Council for Economic Advisors. Professor Baier's research interests focus on understanding the causes and consequences of globalization, the economic impact of free trade agreements, and economic growth. His knowledge of economic data and where to find it makes him an astute observer of the American economy. He's also a longtime instructor in our Economics for Leaders program, and I'm grateful for him giving today's presentation. A recording of this webinar, along with Professor Baier's slide deck, will be posted on the FTE website 1 to 2 days following the conclusion of his presentation. We ask that you withhold questions to the end of the program, and please use the Q&A feature when submitting a question. There's also an upvote function that we encourage you to use to upvote questions that you would wish Professor Baier to answer. Following the presentation, we will have a short evaluation and ask that you take a moment to complete that. So Professor Baier, I'll turn it over to you now.
Thank you, Ted, for that nice introduction. And again, I would like to thank FTE for giving me this platform this evening to kind of go over what I think is Biden economics in the state of the economy. So hopefully I'm going to go ahead and share my screen. I hope this works. Good, I think it has. And so a lot of what I'm going to say today is going to be really the state of the economy and how it relates to Biden economics and to a certain extent on Trump economics. So I thought by this time when we had set up this seminar that the Biden economics plan would have taken a better shape than it has. But as we still see today, it's still being negotiated, especially the infrastructure package. So I'll give some discussion at that at the end. But again, I think there'll be enough of Biden economics, and I hope enough on the current state of the economy that you'll find this well worth your time. Of course, I encourage you to participate in other FTE programs. I think they do a fine job of presenting economics and some of the complex issues in economics in ways that are very understandable for very wide audiences. And so I think, again, I appreciate Ted and what everyone does at the FTE. I'd also like to push a little bit out today that we opened up or started a new website at Clemson. If you go to the Department of Economics at Clemson, we started a new website called Clemson Economic Trends, where we post kind of our thoughts on regional, local, and national news, and make many of these charts that you'll see here today available for everyone. So enough of the long introduction on my part. Let's go ahead and get started. So again, as we know, the economy was moving along fairly well until the beginning of COVID-19 that impacted the economy at the beginning of March. And I'm not going to spend a lot of time going over COVID cases and the rise and fall of COVID, but we certainly know that one of the things that's happened in as a response to COVID that we haven't seen before as economists is, generally speaking, economic series have a tendency to be relatively persistent. That is, once they start moving in one direction, they have a tendency to move in that direction till some abrupt change happens. And even with an abrupt change, those data series start to trend maybe down or level off or move in the opposite direction. That was completely different with what we saw with COVID, that we saw large breaks and big jumps in economic data that we have never seen before. So kind of one of the overall things I want to say about the state of the economy and Bidenomics up front is we can make projections about how we think the economy is going to move in the next 6 months, year or so time, but really the health of the economy and the health of the US is really going to be, again, come down to how we address COVID-19 and the health issues associated. If we have no other type of COVID variants, and if the numbers stay relatively low, I would expect that the economy continues to recover. But if there's a new strain, a new variant, and case numbers jump up again, I would expect, probably somewhat of a similar drop in economic activity. So with that in mind, again, the health of the economy is going to depend also on the health of the health sector and how COVID is addressed. So again, the brief outline of what I'm going to look at today and how I'm going to talk about things, because it's related to the state of the economy. We're going to look at GDP and its components, kind of highlight what I think has been supporting the economic recovery. We know we had a dramatic drop in GDP back in March and April of 2020, but we've had a pretty good solid rebound, even though we're not all the way back to where we were before. I think the rebound has been faster than what most people have anticipated. So I'm going to talk about or discuss what's supporting the economic recovery. Talk about labor markets. There's lots of things still going on in the labor markets. Even though the unemployment rate's down to 4.8%, there are still some persistent lingering effects that need to be addressed. And it's not clear what are causing some of the lags in reemployment. And I'll talk about those. I'll talk about inflation as well. Again, for the first time in 15 or 20 years, it seems like inflation has been being mentioned in the daily news, and I'll discuss how inflation is related to supply chain disruptions. And I think my view here today will be a little bit different than what you hear on the local news or what's often debated in the press. Of course, I don't think you can talk also about what's happened in the last 2 years without discussing how it's impacted the debt and deficit. And again, the last thing I'll end with tonight is a discussion of the infrastructure package. Even though I don't know what form it's going to take, I'm going to just discuss some aspects of it and give you a just kind of a framework, even though it's not very quantitative, but a framework in terms of how I think infrastructure package will work. When do I think it'll be successful, and when will it likely to be less economically successful? And then I'll say I have a couple concluding remarks if you guys still have patience for me at that point. So again, the road to recovery, as we think about the recovery in the Biden economic agenda, we should keep in mind that the Biden policies are not only designed to address the economic effects of the pandemic, but there are also additional things that President Biden liked to address. One of them, as I'm going to highlight in the next couple of slides, is to address the long run economic growth of the economy. And what I'm going to highlight in the coming slides is over the last 20 years or so, economic growth has lagged behind what it had done in previous decades. And part of the Biden economic agenda is to boost, in some sense, our long-term economic growth. That is, make capital and labor more productive. Of course, another objective of the Biden economic agenda is to shore up the middle class and deal with some of the rising income inequality. Again, this is largely going to be contained in his infrastructure package, which he refers to frequently as the human infrastructure package, again, because we don't know what shape that'll take quite yet. I'll have a little bit less to say about that. Of course, he also wants to extend healthcare, invest in green energy, physical energy, and as I mentioned, human infrastructure. I'm mostly going to address the large economic points of the current recovery and the Biden plan. I'm not going to have much to say on green energy. I'm happy to take any questions about that. And again, my discussion of physical infrastructure and human infrastructure will be a little bit vague because we don't know the size or the extent of that package quite yet. So again, if we go back to kind of our standard definition of what we all refer to in our introductory economics classes, we have our standard measure of output or income or production, that is gross domestic product in the US. And I dated all the way back to 1947, just so we could see a long view of GDP growth. But as I mentioned, if you kind of break up GDP growth by decades, and what I did was average annualized growth over each of these decades, what you'll see is the decades of the 50s, 60s, 70s, 80s, and 90s had much higher GDP growth than what we've seen over the last, say, 20 years. And in fact, it's almost half as large. So again, one of the things I think both the Biden administration and the Trump administration tried to do, again, through different forms, they tried to address why has the economy in the last 20 years underperformed relative to how it did in the previous 50 years. And to give another sense of, again, this is going to highlight, so if here's where you could see that more clearly, if I draw in the trend line of GDP over time, and I say we were a long trend up until about 2007, what you could see here is this slower economic growth has led to a pulling away of where we would be if we would go along the trend line. Well, how big is that gap? Well, that current gap is 11% in the year 2020, and or measured in the last quarter we have in 2021. Well, how big is that? What does that mean? And what does 11% mean? The way to think about that is to take, what GDP would be in, say, 2021, divide it by the size of the population. And what that tells us is if we had grown a long trend since 2007, that is a rate of around 3.3% a year rather than 1.67% a year, income per person in the US would be about $5,000 higher. Again, in a household of 5 with my wife and 3 children, I know we could certainly use an extra $25,000 a year. So again, highlighting here the importance of economic growth and how GDP growth compounds over time, and how what may seemingly be small differences after just a few years, 13 or 14 years, can lead to sizable effects in terms of living standards for individuals. And again, you may think that, the bad experience that we had in the 2000s and the 2010s of lackluster, slower economic growth was due specifically to the Great Recession or the subprime crisis or the pandemic. But if you look at annual growth rates going back to, say, 1990 through 2020, so basically this is covering the Clinton years, this is the beginning of the Bush years, this is the Obama years and the Trump years, what you can see, and this black line here represents the average growth rate of the economy since 47 up to 2007. In almost every year, GDP growth has been below the long run average of 3.3%. It's every year from 2000 on out. So again, the slower GDP growth isn't just the Great Recession, and it isn't just the pandemic. There are other things that are going on. I think both administrations, both the Trump administration, the Biden administration, have tried to implement policies that would get growth back up to, again, this long run trend of 3.3%, which is the black line, or the growth that we had during the Clinton years and the internet boom, where growth was over 4% in many years. So again, one of the fundamental points of both administrations, and the Biden administration now in particular, is what can we do about long run economic growth, not just coming out of the pandemic. But as I'm going to argue, our response coming out of the pandemic has been a lot better than what experts thought it would be. If we go back to thinking about where we were in April 20, 2020. I think most people inside the Fed, inside the government, believe that the unemployment rate would exceed 20% by the summer of 2020, and would then be over 10%, still above 10% by the end of the year. And again, the economy outperformed that. So again, to get a little bit better understanding of the recovery, we're going to go back and think about not governments, but we're going to go back and think about GDP and think of its components. So again, when we think of GDP and how we typically do it in our introductory economics classes, on the spending side, we break it up to consumption, investment, government spending, exports, and imports. Important thing I want to highlight here again is that, again, consumption's roughly 2/3 of GDP. Government spending and investment spending are roughly between 15 and 20% of GDP. So one of the things I want to highlight here is one of the things that's really spurred the recovery coming out of 2020 has been the dramatic growth in consumption. And so again, let's think about understanding the contributions of GDP, of the expenditure side of GDP growth to the growth in GDP. And again, there's going to be no quiz at the end of this, but there'll be a little bit of math here. So again, GDP growth is a combination of the growth of all its components, like I mentioned before: consumption, investment, government spending, and net exports. And it's going to be a weighted average of these components. And so the way to think about it, think of consumption and the growth rate of consumption in any year. And if consumption accounts for 2/3 of the economy, and if consumption grows by 3%, then we can easily calculate consumption's contribution to overall GDP growth by taking that 2/3 and multiplying it by 3%. 2/3 times 3% gives us 2%. And then we say consumption contributed about 2 percentage points to GDP growth. So whatever GDP growth was, if GDP happened to grow by 4% that year, we would say consumption accounted for roughly 50% of GDP growth. So what we're going to see here is really the main driver, an important driver of the rebound that we saw coming out of March and April of 2020 was the dramatic increase in consumption. So if you remember back the earlier slides, how I showed that GDP growth was kind of lackluster coming out of the Great Recession. So here we go into the Great Recession, and here we see that consumption was, again, underperforming relative to trend. Trend is growing faster and kind of pulling away. And about the middle 2010s, consumption growth started to pick up and was growing roughly at trend. Of course, we had this big drop in consumption as people went into self-imposed lockdown and government mandated lockdowns. But the interesting thing that came is to look at how much consumption bounced back after the pandemic hit. Again, this is a much faster rebound than what we saw coming out of the Great Recession, and consumption spiked back up, and that's helped us a lot in terms of getting GDP growth back up, getting income growth back up, and help moving employment along. Because again, remember, employment is a derived demand. So if there are more people out buying goods and services, there's going to be more demand for those workers as well. And so again, up until from 2000 to 2019, GDP consumption growth was growing about 2.2% per year. Another way to look at the same thing, and this is more daily data, is this is data put together by an interesting website, and I encourage you to go look at it. It'd be great to use some of these data here for their students, because they include data not only on spending, they have data on employment, and it's daily data. You could just download images of the data, or you could actually download the data if you want. This is national spending relative to where it was. So again, think of it something on the consumption side, relative to how much we were spending in January of 2020. So of course, in January of 2020, we're spending, the percent difference was about 0. Then the pandemic hit in March, and again, spending dropped dramatically. But then over time, it rose up quite a bit. And you can see where we are now in terms of this measure of national spending. We're roughly 24% higher than where we were back in 20. So again, the consumption rebound has been quite dramatic. And if I draw in a couple of these lines, these lines are drawn in, and what they highlight is, again, how the government contributed to some of the rebound of economic activity. Each of these lines represent when the government stimulus checks started to go out. And what you can see is when those checks went out, and this one should be over a little bit more. When those checks went out, you saw noticeable increases in consumer spending. Again, as the $1,400 checks went into our deposits, you saw more and more individual spending. You could see that a little bit more clearly. Again, this is one of the nice things about Opportunity Insights data. They allow you to break it up by, in some sense, lower income groups, higher income groups, and middle income groups. Once again, you can see roughly at the time of these, roughly at the time that the transfer payments went out, or the $1,400 checks went out to individuals from the stimulus package, you saw notable jumps again in spending. In particular, again, it makes sense and it's quite intuitive. The biggest jumps we see here are occurring with lower income households. Again, they probably had bigger needs, whether it was rent, whether it was food, whether it was other necessities. So when those checks came in, they went out and spent quite a bit of that. Middle income individuals responded, but they didn't respond as much in terms of spending. And again, we see a little bit of behavior by higher income households, but they didn't seem to respond as much to the stimulus checks, probably for two reasons. One, they already had enough discretionary income or savings where they didn't need to tap into it. And two, not every high income household received the stimulus checks. So again, they were going to be less responsive. But again, I think this clearly makes some economic sense in the sense of those stimulus checks enhanced spending by the individuals who, again, probably had the biggest need for the spending. Another way we think I can see the dramatic change in consumer spending has been by the change in spending in terms of retail, trade, and in food services. Again, going back, just looking at things historically, if you go back to what happened during the Great Recession, we seem to drop below what we were spending in terms of retail, trade, and food services. Again, growth lagged behind for a little bit. The pandemic hit, retail, trade, and food services again dropped quite dramatically. But again, in the ensuing roughly year and a half, the growth in retail sales has increased by quite a bit to the point where retail sales is about 11% above trend, not below trend. So when we look at what has been one of probably the main driver of what I would say this economic recovery that we've seen so far, the main driver is coming on the consumption side, the consumers coming back to the market and buying goods and services. And again, one of the reasons that led to that, and show it here, I think we can highlight it, is this graph represents real disposable income starting at about 2017. Again, the red line represents the average growth historically going back to, I believe, 1990 for the growth in or the trend growth in disposable income. And then the pandemic hit. And again, notice what happens in the pandemic. We have these three spikes. Again, what are these spikes related to? These spikes are related to the stimulus checks going out to the households, the enhanced and the increased unemployment benefits leading to income and disposable income being higher. And again, more checks being sent out, additional checks being sent out, and the extension of the unemployment benefits. So again, one of the things we see is one of the things that the government did in response is they got checks out to households. This boosted up disposable income and really helped to support the consumption growth that we saw before. And then now to compare this back to when I was in the White House, you know, what occurred back in 2007, something I helped draft, we wrote basically one stimulus check that went out. It had a little bit of spike in disposable income, and then that's all that happened. Then the Great Recession hit, and you saw disposable income drop pretty dramatically, again, below trend. Now, one thing I should say, and up to this point, this looks like a good story and a great story, and it makes everything it sounds on the side of government spending is they did everything right. And I would go along with, they did lots of stuff right here. And it's been important to get the checks out to individuals. But But what we should note here, and what's important to note, is that income is still well above trend. Not all of that income has been spent by consumers. They spent, some of the estimates say that households spent about 20 to 30% on goods and services. About 20% of that money was spent on paying down debt, which we again think is a good thing, because if some other event occurs, then people aren't going to be as financially constrained. But that still leaves about 40 to 50% of those stimulus checks sitting idle, or sitting in cash balances. And again, as the economy recovers and we open up, and what I'm going to argue in a little bit farther down the road, as the economy opens up, remember, individuals are sitting with relatively more cash than what they would expect to happen. What do individuals do when they have more cash than what they like? Well, they try to get rid of it. They either buy assets, think of buying stocks, bonds, or put it into some type of non-monetary asset, or they go out and buy goods and services. So again, what I want to highlight and what I'm going to say here is, while these increases in checks and stimulus packages and an extension of unemployment benefits certainly help the recovery, they may be also planting the seeds for inflation, because as the economy opens up and people spend more of their cash, that may have more inflationary pressures. And we'll see that a little bit later in the talk. So again, some quick takeaways from looking at consumption. Consumption has rebounded rapidly coming out of the recession, coming out of the pandemic, if using the term out of the pandemic loosely. The rebound in consumption was supported by the stimulus packages that were passed both in the Trump administration and the Biden administration. So both administrations did have some play in this. And then again, throughout the rest of the year, we would expect some continued support. While the unemployment benefits are declining because we're no longer getting the federal supports, we still have the advanced child tax credit, which you may see showing up in your checking account from time to time. Again, those additional injections of cash will help to continue consumer spending as we go along. So again, I would expect consumption to continue to rise again over the next, and be one of the main drivers of us coming out of this pandemic, economically speaking. If we look at on the investment side, plants, machines, and equipment, the purchase of plants and machines and equipment, again, let's remind ourselves that even though investment spending is about 20% of GDP, it is the component that is the most volatile. And so can be the tail that wags the dog. So, and you can see investment here can drop at any point in time by as much as 20%. It can go up. And then this is year over year growth in investment and purchase of plants, machine, and equipment. It can go up by as much as 20% year over year. So there's wide variation. Again, going back to the formula I had before, if investment spending is roughly 1/5 of GDP or 20%, and investment goes up by 20%, then 0.2 times 20 tells us the contribution of investment or the purchase of plants, machines, and equipment have added about 4% to GDP growth. One thing I want to highlight here is you should look at this with a little bit of a jaundiced eye. So this looks like investment growth was real high in the last quarter, but that's also coming off that very low base where we were in the last quarter when investment dropped a lot. So again, this real high 20% isn't off kind of a normal base. It was off a very low point. The one thing I think I would like to highlight and say about investment is still, to this day, uncertainty about the resolution of the pandemic is going to cloud investment decisions. I wouldn't anticipate many firms or many industries building new plants, building new office space, building, say, new restaurants or new places of business until there is some resolution. Again, some certainly will. Again, the places that allow for a lot of mail order stuff and home delivery store stuff, goods and services, we would expect those to increase in terms of their investments in terms of warehousing and delivery and vehicles. But other places, think restaurants, think office buildings, those type of investments, there's not going to be a lot of growth there. So when we look forward going out the next 6 months, year, maybe even 2 years, I wouldn't expect to see a lot of GDP growth coming from growth in plants, machines, and equipment, largely again due to the nature of the pandemic and the uncertainty it's created. Again, consumption, I believe, is going to be the main driver. We may get some investment growth from the housing sector, because remember, housing is kind of the odd component that's put in investment. And so we know in lots of stories about the deurbanization that's occurred following the pandemic. So some of the boost that we see in investment spending may be coming through residential investment. So now I'm going to switch over to unemployment and thinking about, what has been going on in terms of unemployment. I guess the graph that you almost have to show anytime you're thinking about labor force and employment is what's happened with unemployment over time. So again, this is one of these graphs that, again, where you see the relative persistence of economic variables that they have a tendency to go in one direction for a long period of time, and then they turn and go in the other direction. And I wish I would have shaded in recessions, because I think an interesting thing that we notice about unemployment is that unemployment typically lags a little bit in terms of recessions. And again, the way to think about it is imagine that the economy starts to slow down. Well, the initial thing employers aren't going to do is they're not going to initially fire a bunch of workers or lay people off. What they typically do initially is cut back on hours, change the shifts around, but they maintain employment at least for some period of time. It's not till the recession deepens or gets worse till the unemployment goes up. Again, so there's going to be some persistence in employment and unemployment during normal times, but not during the pandemic. In March, unemployment went up to about 5.5%, and then in April it shot up to about 14.8%. And we know now it's again dipped down to about 4.8%. But again, I think most people know when we look at unemployment, we kind of do so with a jaundiced eye, because normally we think 4.8% employment is low and gives us an indication that the job market and everything the job market is performing well. But I think anyone who drives around their town or looks on, through local media or scans things, will see all the help wanted signs. So we know that there are some issues associated, again, with the labor market. Again, the next graph I'm going to spend about 2 seconds on, and the pandemic really makes it hard to depict our normal graphs that we would show over time. So this is employment changes in non-farm payroll from 1990 to 2021. And again, the nature of the drop in employment in April of 2020 and the rebound that occurred in May and June makes all these other observations look tiny. So what I'm going to do is I'm going to kind of pull that period out and first focus. So again, so we have a reference point. This is employment changes in non-farm payroll. So again, these are jobs created net jobs created each month in the economy. So during good times, or not during good times, but on average, if you go back to 1990 all the way up to 2007, each month on average, there were about 131,000 net new jobs created. That is, employment went up by 131,000. I can net out all the recessions and stuff, but that still only bumps that number up to about 100. I would say during good times, when we're adding jobs, we're only adding about 140,000. In March and April of 2020, the U.S. economy lost more than 22 million jobs. Okay. And so I don't put that spike in, but what I do add back in is the recovery. And what we can see then is in May, we added almost over 2.8 million jobs. In June, we have added almost 5 million jobs. And if we added up all the jobs over time, we've added back about 17 million jobs. And here you can do the math and you can see, well, we lost 22 million jobs in 2 months, got about 17 million back. We're still about 5 million jobs below where we were in 2020. So again, still a lot of recovery that needs to be done in terms of employment and getting the jobs back. And it's kind of distorted how we think of things. Again, so in the last couple months, and if you paid attention to the first Friday of every month when the unemployment number comes out and the jobs numbers come out, the last couple months have been a little bit of a disappointment that there were only 366 new jobs, net new jobs created, and 194 net new jobs created. But going back to the last slide, we're still doing much better than we were kind of on average in normal times, even if we net out the recession. So again, the economy is still recovering, still adding jobs back, doing it at a pace that better than we normally do, but we're just not accelerating like we would like. Not every month is going to add nearly 1 million jobs back, and we got a little bit spoiled again in the previous couple months that we thought we were going to add 1 million back each month and get back right to where we were by the end of the year. That doesn't look like it's going to happen. Again, kind of breaking things up a little bit. And I've used this slide, kind of similar slides before in COVID talks, but it's always important to look at is what sectors were most acutely impacted by the pandemic. And it's not much of a surprise that the pandemic, again, was spread by people being in close proximity to each other and potentially close quarters. So the industries like leisure and hospitality, education and health services, primarily health services, education was not impacted as badly in terms of job losses. And professional services were the main areas in where jobs were lost, and you can throw in retail trade as well because of people coming out. So more than 1/3 of the job losses that occurred in the economy at the beginning of the pandemic were in leisure and hospitality. And if you add in the professional business services and retail trade, that gets us up to about 60-some% of the jobs lost during the pandemic. Again, not a surprise that there's service sector jobs that typically required one-to-one or many people interacting in a space in which the disease or where COVID could spread. Now, again, I'd like to then see how far we've come since then. So again, these red lines are the same graphs, they're the same bars that were on the previous. So in leisure and hospitality in April and in March and April, we lost over 8 million jobs in leisure and hospitality. You can see we've had quite a big bounce back. We've got almost 7 million of those jobs back, or roughly 70%. But again, we're still like 1.5 million jobs away from being back to where we were at the start of the recession. You can kind of eyeball all these data, and you can see roughly we're about 70 to 75% of the way back in most of the service industries. Again, the one industry that we're doing a little bit better, and it's not too much of a surprise when you go back and you look at what the retail trade looks like. You can see employment is almost all the way back in retail trade. So again, here's an interesting chart that I think I put in one because it's interesting, but two, I think, and I haven't labeled it, that was intentional, because this confirms again what I kind of mentioned, what we observe when we drive around town or we watch the local news, or if anyone still subscribes to a newspaper or flips through the internet through local things in the internet. So what are these two lines? These, again, let me highlight what these represent. On this graph, these are in thousands. So the blue line here actually represents hires. And so what this point say here means that in any month, there were roughly 5 million people, because it sits in between 4,000 and 6,000. There are roughly 5 million people who were hired each month. So the blue line represents hires. And you can see in good times, here's good times before the Great Recession, on average, we're hiring about 5 million people, or here close to 6 million people per month. What is the black line then? Well, the black line is job openings. And what you can see is this dramatic jump up in job openings that has occurred in the last 6 or 7 months. And again, it distorts everything. So this is a relatively new series that we keep as economists that incorporates hirings, firings, and quits, as well as job openings. So this is an entire data series. So this is something that we've never seen like this before, where job openings have pulled away so much from hires. And again, so that explains, this is the data that is the data graph that is consistent with what we observe in terms of all the places looking for employment. Hiring hasn't jumped up to catch up with that, but lots of firms are looking. And again, probably one of the reasons why openings and employment are so high, I think part of it is because firms are reluctant to add productive capacity. So in the short run, in the very short run, and even in intermediate run, the way to address increases in demand with a given capital structure is to hire more workers. So as they see their business coming back and they don't want to make the investment in plants, machines, and equipment, they're trying to find workers to find that. And again, openings are rising faster than hiring is occurring. Again, here's another graph that shows what's happening again in this labor dynamics situation. Again, this kind of highlights going back to how many jobs are created each month. We can see the blue line once again represents hires. The red line represents separations. So think of those as quits and layoffs. And you can see in normal good times, on average, the economy is adding like roughly 5 million jobs in new hires, and they're losing about, well, I should say 5.5 million in hires, and they're losing about 5.2 or 5.3 million jobs in terms of people quit or being laid off. So the net effect is that chart that we saw before, or the graph that I depicted before, the employment change in non-farm payroll. So again, one thing that makes the US labor market so much different, I think, than labor markets and even more, even in developed countries, is the amount of churning that goes on. Roughly in a year in the US labor market, we'll have 62 million jobs created, and we'll have another 60 million jobs destroyed if we have 5 million jobs being created each month, and a similar number being lost each month. Again, what you saw here in during the pandemic was a tremendous amount of layoffs, and then hiring dropped quite dramatically. Again, continuing with this idea of the dynamic nature of the job market. Now I broke the job separations into two different components: quits and layoffs. So layoffs are the black line and quits are the red line. And a couple things I'd like to highlight. A couple things I'd like to highlight again here is, most people don't like, as I often say, and you may have heard me say this before, most people don't like quitters, but economists certainly do. That when we see quits rising, as we do here, and then again more dramatically here, we think that's indicative of a healthy labor market. Why? Because the only reason why you're getting lots of people deciding to quit their job or move on is because they have better job offers out there. So again, what we observe from our 30,000-foot view is when quits go up, we think that's a sign that the economy is doing better, because we believe it's the case. When quits rise in mass, or in general rising over time, that means there are better opportunities for workers and they're moving into better jobs, or they perceive better opportunities. And you can clearly see the rate of quits here are rising more dramatically. And why are they? It shouldn't be much of a surprise that why they're moving is because they're better job opportunities. That may be because of benefits or working conditions, but it also is likely to be because of wages. So the red line here in this graph presents wage growth, and this is wage growth. The red line is wage growth for individuals who switch jobs. Blue line, or dark blue line here, is wage growth for the groups that stay. And again, what you should see here, or I'd like you to see, on average, you're going to see the wage growth for switchers to be higher. Again, why are they switching? Probably because it's a better job offer. It's not always true, but it's mostly true. So we would expect the wage growth of people who switch jobs to be growing faster than the people who stay at their job. But again, we see a notable pulling away here, something that we haven't seen in quite some time. That gap is almost a 2% gap difference in terms of wage growth. So again, again, this kind of sort of confirms again why we why people are switching jobs. And another thing I've noticed is I've talked with on the street, boots on the ground, talking with local employers and local workers, for quite a bit of time, it was the case that you would have local retail establishments offering people, $500, $1,000, $200 signing bonuses if you would come and work. Well, now when I talk with some of the local business establishments, they're offering some of their workers $500 retention payments if they stay and don't go take another job. So again, we're seeing these employers kind of adjust. And when I talked with some of the employers, I asked them, why are you paying $500 or $1,000 bonus, whatever the bonus was? Why are you making pay inducements that way to attract people? And the basic idea, they said, look, our demand has jumped up a little bit higher than what we've ever seen, but we don't know if it's permanent. And if we offer this higher wage rate, then we're kind of locked into that wage rate. And if most restaurants and retail stores, they work on pretty thin margins. And so if they get stuck at that higher wage rate permanently, it makes them much less profitable, maybe even difficult to stay open. So that's why we've seen a lot of hiring bonuses or retention bonuses, and not as much, some, but not as much, again, in terms of wage increases. But again, wages are starting to rise overall. So again, kind of going back, and this again comes from Opportunity Insights to get kind of a national view of what's going on by income level. And this shouldn't be much of a surprise. If you look at employment at the national level by income group, what you see is low wage workers are making about 25% less than what they were at the start or prior to the beginning of the pandemic. And high wage workers are making about 10% more. Middle wage workers their income hasn't changed much. Again, this shouldn't be too much of a surprise. Why? Because the high wage workers, we think most of them probably didn't lose their job. These are individuals who could probably easily transition into working remotely. And so they were just as productive, worked just as many hours, and again, maintain their wages, where a lot of the low wage workers were probably associated with leisure and hospitality and other lower perhaps paying service jobs. And so those were the individuals who lost their jobs. And again, many of those people are still unemployed. So again, that counts for the lower wage. But again, but we could see again, the uneven nature of how the pandemic has hit low wage workers versus high or middle wage, not middle age workers. Speaking of middle age, here's a graph with some middle age in it. But again, this is again to show sort of that the impact of the pandemic in terms on employment and labor market outcomes was, no matter how old you were, seemed to be bigger in lower income categories. For those individuals between ages 21 and 35, the estimate here is unemployment went up dramatically for lower income individuals than higher income. We see the same thing for middle-aged workers, and we see a similar pattern again for older individuals. Again, so that no matter your age, it seemed like the impact of the pandemic mostly hit the individuals who are earning lower wages. And again, if we think of these individuals who are in the labor and hospitality or similar entertainment industries, where they're going to be the ones that were going to be impacted the most. So again, quickly going over, I think the employment situation, employment has been slow to rebound. The real challenge, I think, now that we see has been for employers to fill vacancies. And why is that? And we haven't fully fleshed out exactly what is going on. And you've probably heard many of the candidates for why employment hasn't bounced back, given the number of job openings we see. One of the arguments is that the extended or expected continuation of unemployment benefits have acted as a disincentive for individuals to go back and take a job. And again, I've talked with employers who say that it's hard for them to, this is all anecdotal evidence. I've talked to employers that say, they have people who are making more than being unemployed than what I could pay them. I've talked with individuals that say, look, these extended unemployment benefits allow me just to be a little bit choosier to find a better fit for the type of job and the type of lifestyle I want. So again, people are kind of working their way through that. Another argument, again, that's often made why employment has not responded to the growth in the demand for workers is there are lots of parents who have young children at home that have to do daycare, or maybe they're taking care of their parents, and those type of restrictions, worrying about their health, worrying about their safety, has slowed down their reentry back into the labor force. Another thing that I hear common that workers are reluctant to work in certain industries. I know people who have talked with people who were bartenders or wait staff who have told me that that's not the industry that they want to go back into. They're not even certain post-pandemic if that's the industry that they want to go into. So they're searching for someone else. Then I also think that there's a general group of people that the pandemic has maybe changed their outlook on careers or their life. And so they're looking for different career opportunities, different ways that they could have a more meaningful and satisfying life. So I think it's hard to tell which of these factors have mattered the most, or which factors have mattered at all, maybe. But I think as time goes on, as we get a little bit more better data, we'll be able to take a look and better be able to disentangle the importance of these things. My guess is they've all been important contributors to the slow rebound in terms of employment. And again, the last thing is, again, this is something I hear when I talk with individuals who are unemployed and when I talk with people who are looking for employment. There's just a general increased desire to have the option to work from home. And I've talked to a neighbor of mine who works at a Michelin plant, and she'll say, a lot of the people that they bring in, they'll say they want to work at home most of the time. And it's kind of somewhat difficult working from home when your job is a factory line worker. So again, but again, I think there's going to be a general readjustment, I think, on both the employer and the employee side of how we what is a day's work, when does it begin, when does it end, and how often do you need to be in the office. So kind of switching subjects now over to looking at inflation. For much of my last 20 years as being an academic professor, this is one of the more boring things I've talked about when I had teaching my principles of macro class, because 17, 18, 19-year-old students have never experienced high inflation. Even most inflation they've experienced has been 2%, and it's been roughly constant for their entire life. Now we're seeing a little bit of action here on inflation. The two different ways that we can define inflation is by the CPI or the Consumer Expenditure Price Index. And we see both of those have moved up. And one of the big debates that's happening not only on the policy side, but also among academics, is this transitory, or is this more long lasting? So again, a lot of the transitory people just make the argument, oh, these are just supply chain disruptions and they'll soon pass and we'll go back to normal. Other people will argue that this inflation is going to be a little bit more persistent. And what you'll find out here rather quickly is that I'm going to be more in the camp where I'm kind of straddle both. But I think my belief is that I think the inflation is going to be a little bit more persistent. So let me spend a few minutes explaining why I think that's true. And I'll try to wrap things up in just a couple minutes. So this is money growth, M2. If you remember from macro, M2 was sometimes referred as transactions money. A key thing you'll see on the next slide or a slide after is M2 is the Federal Reserve has less control over M2. M2 is basically controlled by households, how much they want to buy in goods and services, and the banking sector. So again, what we see here is that M2 over time has been roughly constant, growing at roughly a constant rate. Even during the Great Recession, when the Fed pumped a lot of money into the economy and the monetary base, we didn't see much of a movement or much of growth in M2. But then you get out here in the pandemic and you see this tremendous growth in M2. What was going on? So if you look at what was going on, and again, kind of highlight that, put that last chart in numbers from January 2000, so for roughly 20 years, the growth of M2 was about 6%. And over that, at the start of the pandemic, they really, this is annualized growth rate, so it distorts things a little bit. They really ramped up how quickly M2 grew. At an annualized rate, it was about a 50% increase. But over the last year or so, 13 months, M2 growth has been about double what it had been historically. So why are people all of a sudden holding money? Well, they're not. I'll come back to this. Let me come back to this slide in a minute. What is actually going on here? I'll tell the story back here. That'll be a little bit better. Sorry. What has gone on here is this hasn't been a decision for individuals to hold more money. This is your basic Milton Friedman story of a helicopter drop. These are the stimulus checks. These are the other other PPP checks, the payment protection program. These are the checks that are going to the child tax credit that are just showing up in individuals' checking account. It wasn't something that individuals decided to hold right away. It was something that was dropped on individuals, where Milton Friedman referred to this as a helicopter drop of money, where a helicopter flies over the city and holds money. So I'll come back to that slide again. So again, why do I think inflation is potentially maybe more permanent? Again, the Federal Reserve has less control over M2. What generally determines the growth of M2 is expected inflation and what I want to do with my money. How do I want to get rid of some of my money? Do I want to hold it in assets or buy goods and services? This recent increase in M2 represents something much different. Okay, it represents the federal government writing transfer checks to households and showing up in people's account. It's like a helicopter drop. And again, go back to one of the early slides where I said people's disposable income has gone up. And what is it? They're holding on this excess cash. So what is the excess cash doing? Well, when you individuals have excess cash, at some point, they decide they either want to use that money to rebalance kind of their position. So they're either going to buy more assets, think stocks, bonds, or whatever, or they're going to buy goods and services. If they buy goods and services, then that has a tendency, again, that gets more money circulating in the economy. And again, that leads to inflation. So now I'll go back to this. So if you remember, again, from an intro macro class, where the velocity of money is basically tells us how frequently a dollar is spent in the economy. We see that velocity was trending down since 2000, but here comes the helicopter drops and velocity drops dramatically. So that means people stop spending money. And that's what we would expect, again, at the beginning of the pandemic and maybe now, because as that money, as the economy shuts down, people don't have a place to go. It's kind of parked in their accounts. But as the economy opens back up, as people get more comfortable, I would expect velocity to jump up. And when that turnover of the dollar starts to happen more, that additional money then will start to manifest itself in terms of more rapid inflation. So what I would expect to occur in the next year is that again, the continuation of the inflation we have. Again, there's a tendency to say that this is due to supply chain disruptions, but again, think in terms of how you would basically draw supply and demand. If I was going to draw a supply disruption, I would have a supply curve shifting back to the left. Yeah, I get prices going up, but I also get output falling. That's not what we're observing. We're seeing output continue to grow. So again, what I think when you talk about supply chain disruptions, remember there's always going to be demand. So when I see all of these freighters sitting in California waiting to get to the dock, I don't think it was from some type of supply disruption or maybe not enough workers. I think that's the U.S. economy's demand coming back, worldwide demand coming back, that has brought all of those ships to the ports to be unloaded. So again, certainly we're running into some supply chain, some supply issues, but again, I think it's mostly led by the increase in demand. And again, an anecdotal story related to that is semiconductors. right? There's been a shortage of semiconductors. Why? It's not because of production. It was because during the pandemic, households increased their demand of semiconductors for electronics and other things to make being at home in a pandemic better. So when the economy opened back up, there was still this heavy demand for semiconductors for home use, but also then the auto industry didn't have the access to the semiconductors that they had before. And again, and they blame it on supply issue, but really was coming from the demand side. So I'm afraid I'm running out of time. So let me quickly go over what I think about the infrastructure package without going into details of what it is. And this is kind of my back of the envelope way in which I think we should, how I would begin to think about whether an infrastructure package is going to be productive. And the kind of the first component is the efficiency in which the government spends. So if we go back to the shovel-ready projects coming out of the stimulus from the Great Recession, that was kind of a rush job by the government, and they did things quickly, and it led to a relatively inefficient allocation of that use of the government spending. So again, what's going to be the key thing about infrastructure is, are we going to take our time? Are we going to pick the projects I think that are going to be most highly valued? The second thing I think that we always talk about in our macro class is the multiplier. Is there going to be a multiplier? Does the government spending raise the productivity? In this case, when we talk about infrastructure, does it raise the productivity of the private sector? Is it going to make workers, is it going to make physical capital more productive? And the key things I think to think about here, again, think of this like a multiplier. And the second thing is, the key is the infrastructure going to be a complement for private capital, human capital, and physical capital, or is it going to be a substitute? Right. If it complements, say, roads, highways, potentially bridges, then it's going to potentially raise the productivity of private capital. If it's infrastructure that private businesses, private households would do anyhow, it's likely to be a substitute and have much smaller, if or maybe no multiplier whatsoever. The third thing that's going to be important for how effective an infrastructure package or any type of stimulus package that relies on government spending is the resource use. Does the spending that the government do pull idle resources, or is there crowding out? And the crowding out I'm going to mention here is a little bit different. So if the government spending is going to take unemployed workers or unused capital and use that, it's likely to have a bigger effect on economic activity. But if the spending is going to, say, pull workers that were working in one industry and use maybe capital that is in some other industry or would have gone to some other industry, the net effect, you may get an increase in public production, but you'll get a decrease in private production. That will have a tendency to push down the economic effects of the infrastructure package. Then the final one that often gets overlooked is the funding distortions. Or how are we going to pay for it, as we were often referred to in our economics classes, is there a deadweight loss associated with that? And so again, there are three ways in which we can think about how we're going to finance the infrastructure package. One is, it could be if we raise taxes. So the relevant question is, what private sector activities are going to be reduced because we're raising taxes for this infrastructure? There's going to be some resource drain that the private sector is not going to do some things that it would have done otherwise. How big is that? How much does it offset the positive benefits of the infrastructure package? The second thing is, if the infrastructure package is financed by borrowing, we have the typical crowding out effect. The increased borrowing can raise interest rates. The higher interest rates can slow down investment. Less private plants, machines, and equipment, and again, can slow down economic growth. So it distorts and pushes down the effect of the infrastructure package. And the last thing I think that we have to mention is kind of the world that we live in that's often talked about now is the modern monetary theory. Another way we can finance the infrastructure packages, you just can print money. And if we do that, that has a tendency to be inflationary. And again, the inflationary aspects may also reduce the effectiveness of the infrastructure component. I think I have more to say, but I think I am better off by wrapping things up and taking any questions before I keep you guys away from your friends, family, TV, economics books, or whatever else you would have to like to look at. So,
All right.
so again, I'm free to take any questions.
Great, Scott. We do have a series of questions. We can probably go, if you're okay, we can go at least probably in about 10 minutes or so. And I thought I'd ask the first question here is from Disney. And Disney is asking, which human infrastructure policy proposals would impact the long-term health of the economy? Paid family leave, subsidies for preschool or childcare, or oops, I just got dismissed. Or sorry, or subsidies for elder care. Sorry.
Yeah, so I think that, this is, so I would lean toward the parental leave or the early child care. So I think, the parental leave, I think having some, more flexibility for households would be good. I also think, again, one of my colleagues here has a couple notable papers that have recently been published that show the real benefits of early childhood care and potentially early childhood investment. So again, I think that pre-K, that 3 to 4 year old can really have a significant boost to later productivity. I think kids learn a lot of potentially a lot of skills that would be more productive down the road. So I would almost go to the 3 and 4 year old pre-K plans. Again, always depends on who the teacher is that you're working with. If that individual is, again, probably can address those issues better than the home, then yes, it is the pre-K.
Okay, Scott. So we have Chad is asking, what has been happening with the labor force participation rate? Have people been checking out of the labor force, as is often brought up in relation to increased unemployment benefits?
Well, I think there are multiple factors that have led to the sluggish rebound of the labor force participation rate. I think some of it are the unemployment benefits, but again, I also think until some of these child care issues are addressed, or elder care issues are addressed, or the health issues that are associated with those go away, I think people again are sitting on the sidelines until those things again are addressed. And again, I also think there's some belief that some of the industries, the food service industries and the entertainment industries, people still are reluctant to go back and take jobs in those sectors. And again, until we address the health aspects of the pandemic, I wouldn't expect those jobs to come back fully.
All right, here's a question from Mike. Mike is asking, do the wage spikes, fast food workers getting large jumps in wages, for example, represent a new reality, last few months of job openings on the job, or panic? Does the spike in job openings represent a long-term or short-term problem, or more likely, we just don't know yet?
Yeah, so that's a good question. It's always easy to go with we just don't know yet, but no, I think what we're going to see is that I think we're going to see more permanent increase in the wage rate of these workers, and I don't think that's necessarily a bad thing.
Okay, a question from Patricia, kind of a two-part question, so I'll break it out here. It says, how do you think the COVID vaccine mandates will affect employment after individuals who choose not to take the vaccine are let go or have to resign from their positions?
Yeah, well, yeah, go ahead.
I was gonna say, it says, just add on, it says, do you think this will increase unemployment a little, moderately, or a great deal?
Yeah, so I think it's going to have a relatively modest effect on the unemployment rate. And again, I don't think it is again in a health aspect. I think it's probably the right thing to do. again, from an employment aspect, is probably quite, it's a negative. I think a negative. It's going to slow down productivity because you're going to lose some valuable workers who may have been with the company for a long period of time. So not only do they have their own, say, human capital, but they have a fair amount of institutional capital, and that will be difficult to replace. So I think if the size of those individuals, or the amount of individuals who lose a job because of that can have a real drag on productivity.
And then this is the other sort of part of Patricia's question. She's asking, do you think the two bills in Congress will increase not only government expenditures, but will it increase consumption as well, therefore increasing aggregate demand? Will this then increase the price level? And will we then continue to see higher inflation levels?
Yeah, so that, again, I think that's a good point. Again, it depends on how the government, how the wheels hit the road in terms of the two bills, and if it gets condensed to one bill. I certainly would expect an increase in expenditures, again, on the government side. So I would expect G going up, and that's going to have that's going to shift out aggregate demand. I also would anticipate, again, with the addition of the child tax credits and some of the other kind of monetary stimulus, but it's coming on the government side. So I'm using monetary stimulus incorrectly here. That will also increase consumption. So what's really going to be important here is, where are we in terms of aggregate? If you want to think in terms of aggregate demand, aggregate supply, is where are we on the aggregate supply schedule? Do we think we have a lot of slack resources in the economy, lots of underutilized idle capital, idle labor? If that's the case, there shouldn't be many inflationary pressures. If that's not the case, we're on the more vertical portion of the aggregate supply curve, it's likely to be inflationary. My guess is I'm more inclined to think it's going to be more inflationary while still contributing some to GDP growth. But again, I think it's going to lead to a rise in prices.
All right, this can be here the penultimate question. And this is a question by John, and he's asking, which of the tax proposals put forth seems to be the most appropriate for funding the Biden programs?
Yeah, that's so that's a real tough question. I had a slide that looked at that, and so when you look at the overall size, thinking of U.S. infrastructure broadly, again, thinking of productive capacity of the economy, so that includes private capital as infrastructure. Most of the infrastructure in the economy is held by the private sector and developed by the private sector. So I worry about taxing businesses that would slow down private investment, so offsetting the net effect of capital accumulation. I also worry about raising the corporate tax to making us less competitive internationally. And I know there's been some agreements or some discussion of agreements to kind of fix overall corporate taxes, but we went from a point of having one of the worst corporate taxes from an international standpoint. And that's why we saw many of our companies headquartered overseas to being relatively competitive. And I would hate to see us move away from that. So those are the two I'm concerned about the most.
Okay, and then here's the last question for the evening. I know everyone's probably getting a little tired, and you've got to be getting tired too, Professor. I hope I pronounced your name correctly. This is Camise. If I didn't pronounce it right, my apologies, is asking, how does the spending plan for education and student loans impact the labor market?
Yeah, that's a good question. So when I look at one of my colleagues who I worked with at the White House, she does a lot of work on student loans, and when we look at like making community colleges free or more affordable right now, I think, with a little bit of work and by the individuals, most community colleges are already essentially free. And so I think some additional support by the government, I think, will help boost education, at least at the community college level. Another thing that's interesting about student loans, and so I'll take up a minute here to talk about that, is when we look at student loans and we think about student loan forgiveness, we should be careful about how we do that, because we'll hear from time to time of the individual who went to Harvard who has $200,000 of student loans and can't find a job. But those stories are, and again, I'm going to make this analogy, and don't punish me for it, are very similar to the story of, I have a grandmother who lived to 95 and she smoked a pack and a half of non-filtered Camels every day. You can find those anecdotes, but they're often quite rare. When we look at people that have the high student loans, those are typically people with professional degrees, lawyers, doctors, PhD economists. Those are people that typically have the earning capacity to be able to pay it. So I would hate now to retrospectively waive all of that off, because those are the people who have high enough incomes. Where we see the individuals that are defaulting most on the student loans, it's the individuals that have roughly modest student loans of about 5,000 to 10,000, but have dropped out of college. And so I think that's an issue that I think we can address at potentially a relatively low cost, and then continue to support education by providing both local and government support for community college and maybe some other early education. But when I look at the student loan problem, I think when people see the size of student loans, it's important to understand a little bit more of the context, who typically has the large student loans and who are the individuals defaulting. And we would want to target those individuals, again, who come from more modest means, who have relatively modest student loans, and try to help those rather than help my doctor who has $200,000 in loans out, who can I would hope be able to pay for his loan payments. So I hope that answered your question.
All righty. Well, great. Thank you very much, Professor Baier, for your time. Very grateful for you giving us another evening. And I just want to also thank everyone else for participating and tuning in to our webinar. As a reminder, please take a couple of minutes to fill out the evaluation that my colleague Lisa has put in the chat function. And also wanted to tell everyone that we will post this webinar on the FTE website, as well as Professor Baier's slide deck, and we'll obviously send an email out to notify everyone when we do that. But I know we could kept Professor Baier here probably for another hour, but I definitely appreciate his time. So thank you, and everyone have a great evening.
Okay, and again, I would like to thank everybody for tuning in. And again, I hope you have an opportunity to attend an FTE session this winter, or I hope to see you in this summer when hopefully we'll be back in person again this summer. So thank you all for tuning in and bearing with me for over an hour. So have a good night, everybody.
Great. Thank you.